It's time now to talk about the accounting treatment for debt investments classified as available for sale. Remember that these are the securities that the company may hold until the debt investment matures, or they may sell before then. They're not really sure, so it puts them into this intermediate classification. Remember that these investments are reported at fair value on the balance sheet. And unrealized gains and losses, those changes in fair values over time, are not reported in income. They're reported in other comprehensive income. And other comprehensive income, the most important part to take away is that the account other comprehensive income is not a part of net income. So why does that matter? It's just on another statement. We have the statement of the income statement, and then we have the statement of comprehensive income. Why does it matter if it goes on one and not the other? That's the question you should have in your mind. What's the difference? Really big difference, because investors place so much weight on that income statement, on what goes into net income. What are they putting that weight on in terms of doing their valuation models to decide what should the stock price be based on recent performance? I'm going to use that recent performance from net income in order to forecast or estimate future income. And I'm going to use that to estimate future cash flows, discount those back to what I estimate stock price should be. And I'm going to make my trading decisions based on that. So if we're not using the information from the other comprehensive income, it has less importance. And that's what we see over time, is just another account to give investors that information if they're interested in. And we know that most investors are not as interested in this information. So remember, we have the revenues minus expenses gives us net income. Net income plus or minus other comprehensive income. Remember, sometimes net income is generally positive for a stable, more mature company. Other comprehensive income is equally likely to be positive or negative. We're looking at market swings, changes in fair values over time. The markets go up, markets go down. So it might be positive, might be negative, but net income plus or minus other comprehensive income gives us comprehensive income. Okay, so it's a separate statement. GAAP says comprehensive income can be reported directly on the face of the income statement. Most companies choose to use a separate statement. And also remember that at the end of the period, remember, net income is transferred into retained earnings. Other comprehensive income is transferred into a balance sheet account called accumulated other comprehensive income. Let's just start this over. Accumulated other comprehensive income. And this is a component of stockholders' equity. So assets equals liabilities plus equity. And our equity accounts, we have common stock. Of course, we have retained earnings. And we have this other component, accumulated other comprehensive income. This is a balance sheet account component of stockholders' equity. And then if the company buys its stock back, it's also going to have treasury stock, which will reduce stockholders' equity. All right, so at the end of the period, OCI is going to increase or decrease, depending on whether it's positive or negative, stockholders' equity through accumulated other comprehensive income. So the good news is that all the entries are pretty much the same. So same entries definitely for exactly the same for the purchase of a debt investment and the interest on the debt investment or the investment in bonds. Same entries as with a held to maturity bond and same entries as with a trading bond. So if we scroll back up and we look at when we started this and we looked at our entry to purchase the bonds. We talked about this in the entry for the interest. We didn't even say what the classification was because it didn't matter. So our cash will always be $42,000. Our interest revenue will change, but it's always determined as the bond's beginning carrying value multiplied by the market rate times 1/2 because it's a semi-annual bond. So those entries are going to be done whether it is held to maturity or whether it's trading. We saw with the trading, we also had the same interest revenue. We didn't write it out again. We're not going to write it out again here either. But we are going to return to example 1 again. The other thing we need to know is that the accounting treatment for changes in fair value and changes in fair value are also called the unrealized holding gains and losses. I'm just going to abbreviate that as UHGL, unrealized holding gains and losses. They are almost the same. I'm going to say the same except the same as the accounting treatment for trading securities with one exception, and that exception is really important. So bonds classified as trading, except for, so when we had trading securities and we were recording that fair value adjustment, we would, one side of the entry is fair value adjustment. The other side of that entry was either a gain if it was a credit or loss if it was a debit on debt investments. And then in parentheses we said unrealized, comma, net income. What do you think is going to change? Instead of this account, which was used for trading securities, investments classified as trading, instead of this, we use, and guess what the change is going to be? Still unrealized, haven't sold it yet. Instead of net income, we are going to write other comprehensive income. And that's it. That's the only change. So when we redo example 1, for example 1, when we did the trading, we looked at the end of the first interest period, the end of the first year, we had our amortized cost. We were given the fair value. We're going to use the same fair value again, or we're going to get the same exact required ending balance in the fair value adjustment account. We're going to record the entry for the increase in the fair value because we're still going on that same assumption. We're still going to debit to increase fair value adjustment, that balance sheet asset account. And we are going to credit gain on investment, unrealized, and the only difference, of course, is instead of net income, it's going to be other comprehensive income. Okay, so let's continue with example 1. Assume we've already recorded the purchase of the bond investment, $700,000, and we had to pay 663 something. Then we, on 12/31, we recorded the cash interest we received. We reduced the discount, we amortized the discount, and we recorded the interest revenue. Now it's 12/31, and we're assuming again fair value. Same as what we used, the same number we used for when it was classified as trading, 714,943. And remember, amortized cost on 12/31, just like we did before, 671,297. Okay, so we look at the difference between the fair value and the amortized cost. That difference of 43,646. This is what we want the ending balance in the fair value adjustment account to be. Should be, or is required to be, or must be. Okay, so with that, we do a T account for the fair value adjustment account. We want the ending balance to be 43,646. Remember, this is the very first time we're recording a change in fair value, so beginning balance is 0. We need an entry for a debit 43,646. The adjusting entry at the end of the year to record the change in the fair value is going to debit fair value adjustment. So we increase our assets with this debit to fair value adjustment, 43646, and we're going to credit to increase. Oh, sorry. In the real world, most companies use the account unrealized holding gain, and then parentheses OCI. In our textbook, we're using the language, the account title, gain on bond investment or investment in bonds, parentheses, unrealized, and we're showing that this account goes through other comprehensive income. So when we look at the financial statements at 12/31, we'd have the 2024 income statement. This was for, we purchased the security on June 30th or July 1st. We got interest revenue at year end. Our first interest revenue was recorded, 46664. This is the same amount we used earlier. And we have no unrealized gain. And if you're thinking, what are you talking about? We just recorded an unrealized gain. We did, but we showed that it only goes to OCI, does not go to net income. So net income is 46,664. We're going to add in this other statement, 2024 statement of comprehensive income, which is net income, 46,664, plus, in this case, it's an income, not another comprehensive loss, of 43,646. So investors who are interested in comprehensive income or the unrealized gain on this bond investment that may or may not be sold, they can find it on this statement of comprehensive income. And the balance sheet looks exactly the same as it would under any of the other classifications. We have investment of bonds. Well, actually not either of the other two. Looks exactly the same as it would if this was a trading bond. Balance in the discount, 28,703. We have the fair value adjustment, 43,646, and the net investment in bonds account, 714,943, which is exactly our fair value. Now let's continue just like we did in with the trading security. Let's assume we have the same interest. So the interest revenue entry on 6/30/25, and rather than writing it out, is the same as with the trading security. So let's just scroll up to show what was that entry. We collect interest 6/30/2025. We collect the interest. We have debit to cash 42,000, decrease the discount, record the interest revenue based on the carrying value of the bond times the market rate. Okay, so same exact entry. We can write this over if we want, or we can just remember we're going to need on the income statement this 46,991, and that the amortized cost at 6/30 is 676,280. Okay, so that same entry there. If it makes more sense to write that down, go ahead. But again, assume fair value. At the next interest date, 6/30/25, is 710,000. We do, and this is not going to be any different when we're just doing the math here about what is the amount of our fair value adjustment. Fair value is 710. The amortized cost, we did one additional interest revenue and discount amortization. Amortized cost 676,288. And the fair value adjustment balance, the required ending balance, is 33,712. Okay, we should be familiar with this. We saw this with our trading security. The fair value adjustment started off beginning balance 43,646, what we ended last period with. We now want it to be a debit because fair value is higher than amortized cost of 33,712. So what do we need to record? We need to record 9,934. Looks just like what we did with the trading investment. And now when we record our journal entry, we're going to debit loss on bond investment because fair value adjustment, this is a debit to the fair value adjustment account. This is a credit to the fair value adjustment account. So we're going to need to credit the fair value adjustment account 9,934, and the other side of that entry, it's a loss. There's a decrease in the fair value from when we first recorded a fair value adjustment. So this is loss on bond investment in bonds. And then this is unrealized because we haven't sold it, comma, because it's available for sale, other comprehensive income. If we were to put together an income statement for the 6-month period, January 1st through July 1st, 2025, we would have the interest revenue. Remember, I didn't record the entry. The interest revenue was the same. We had done it twice earlier, 46991. We had no unrealized gain or loss. That's going to be included in net income, so net income would simply be the interest revenue. The statement of comprehensive income for the same time period, January 1st through 6/30/2025, shows net income of 46,991, what we have here. And then we are going to subtract the other comprehensive loss of 9,934. That's what we have here. And that's going to give us comprehensive income of 37057. Remember, this is what we saw in net income when it was a trading security. Now we're seeing it in comprehensive income. The balance sheet, same as when it was a trading security. We have the investment in bond investment, debt investment, 700,000, minus the balance in the discount account, which at 6/30/25 is 23,712. And we have a debit balance to increase our assets. The fair value adjustment has a balance of 33,712. I see that right here. And this is going to give me a balance in the bond investment account related to, with all the related accounts, 710,000, which is fair value. It's exactly what I wanted. And finally, let's assume the investment is sold the very next day. Assume the bond is sold the very next day on July 1st. At a price of 712,000. We're going to need to record 3 different entries for this. The first one is we need to adjust the bond investment to its fair value, like the moment before it's being sold. So adjust to fair value. As we've done before, fair value 712,000. The difference between the fair value and the amortized cost, which we said was 676,288. Initial cost minus the remaining discount. And this difference here, 35,712, this is what we want the ending balance in the fair value adjustment account to be. So when we think about that fair value adjustment account, the beginning balance is what we ended last period with, 33,712, and on the debit side, we want the ending balance to be 35,712, still on the debit side because our fair value is above amortized cost, and what we need to record as our adjusting entry is 2,000 debit. So our journal entry, debit to increase fair value adjustment, This is going to increase the assets on the balance sheet, and the credit is going to be to the account gain on bond investment. We're going to write in parentheses that this is unrealized. I know we're about to sell it, but think of this as being the second before we actually sell. And we're going to report this in other comprehensive income. Note that it's available for sale, so not net income. Really important distinction for 2000. Now we have a different entry to record that we haven't seen before on either of the other two types of securities. What we need to do is reverse the previous fair value adjustments. We are going to take them out of other comprehensive income because we're selling them. Remember, other comprehensive income is just this temporary place to put unrealized gains and losses. Now that we've realized them, we want to take them out of other comprehensive income. The total amount. So think about this as the accumulated amount related to this bond investment, the unrealized gains and losses on this bond investment. So what we're actually reversing is the accumulated other comprehensive income or gains and losses on this bond investment since we first purchased it. So what we need to do is we need to move the total or cumulative unrealized holding gains and loss out of OCI, and not just out of OCI. Every period, OCI gets transferred out of OCI and it goes into accumulated other comprehensive income in the statement of stock, in the stockholders' equity, and into net income. So out of OCI and out of accumulated OCI and into net income. So we need to move AOCI into net income, and we need to move the fair value adjustment account. So we're moving two things here, not just one. We're moving that balance to 0. And this is called a reclassification adjustment. Okay, so what accounts do we use? Well, we are going to eliminate the balance and accumulate other comprehensive income using the account reclassification. I've seen it called other things. Our textbook calls it reclassification adjustment account, parentheses, OCI. But what we're really doing is the total amounts of other comprehensive income. We're really moving is that balance that went to accumulated other comprehensive income. And so we had a net income or unrealized gain of 35, so we're going to reduce it with a debit to reclassification adjustment. We're reducing other comprehensive income, which will then reduce accumulated other comprehensive income. And we're also going to reduce the fair value adjustment account. Remember, it had a debit balance, which was an increase to assets. If we don't have the related security anymore because we're selling it, well, we need to get the fair value adjustment account balance to 0. So what this would look like if you think about accumulated other comprehensive income over the period, we increased it by 43,646 on 12/31/24. We decreased it on 6/30 by 9,934. We increased it on 7/1 by the 2,000. And what the balance is in AOCI related to this debt investment is a credit of 35,712. When we're booking this reclassification adjustment, we are stripping out everything from that accumulated other comprehensive income account. Next, we need to record the actual sale. So this is the third part of our journal entry, record the sale. We receive cash. We're selling it for $712,000, so that's what we get in cash. We eliminate the investment in bonds. Notice I skipped a line here. We're going to need one more debit for the face value of $700,000. Eliminate its related discount account. So we're going to debit to eliminate the discount on bond investment account. The remaining balance was 23,712. And then our equation doesn't balance. So what we have is this part of the reclassification. We're going to record the gain on investment and we're going to put it directly into net income. So we're taking it out of other comprehensive income. We're taking it out of accumulated other comprehensive income. And we're recognizing the full gain in net income because we've just sold it. So what are our financial statements going to look like for this date? Just this one transaction, the one sale in 7/1/25. We have gain on investment in net income, 35,712. Our comprehensive income, we have this net income, 35,712. We recorded in other comprehensive income a negative to other comprehensive income here with this reclassification adjustment. And that offsets our net income. On our balance sheet, we have no investment, so we have nothing. That was a lot. So let's look at one fairly straightforward example. Let's assume we buy a bond investment. We record it as available for sale. We buy it at par, so there's no discount or premium. We buy it on 12/30/24 at a price of $92,000. The next day, we're preparing our financial statements. We don't need to worry about any revenue. It's just been a day. Fair value. It's available for sale, so we need to record it at fair value. And fair value is $85,000, so it decreased below its cost. And then we sell it on January 2nd, 2025 for $100,000. The entry on December 30th is easy. We get the asset investment in bonds and we pay out cash at the cost of those bonds, $92,000. The next day, we're about to put our financial statements together. We need to adjust this to fair value. So what do? Fair value adjustment account. Let's see. We have our fair value is 92,000. No, sorry. Fair value is 85,000. The amortized cost is 92,000. So our required ending balance is a negative 7,000. What we mean by that is we want a credit balance of 7,000. What we need to record is a credit of 7,000 to the fair value adjustment account. And what is our debit going to be? Loss on bond investment. And it's available for sale. Of course, it's unrealized. And because it's available for sale, it's going to be reported in other comprehensive income. Okay, so far. Now, the next day, January, 2 days later, we sell it. We need 3 adjustments. 1, bring it to its fair value. All right, so fair value adjustment. It starts off with a 7,000 credit. Fair value is 100,000 on January 2nd. Amortized cost is still 92,000. There's no discount or premium. We want our ending balance to be a positive 8,000 or a debit of 8,000. What do we need to record in order to get it from a negative 7,000 to a positive 8,000? We need to record a debit of 15,000 to the fair value adjustment account. The credit, gain on bond investment, unrealized OCI. That was the first entry. The next one is this reclassification entry. So what we want to do is take the full amount that was in other comprehensive income. 7,000 loss, 15,000 gain. We have a net increase, a net gain in the accumulated other comprehensive income. to wipe that out to zero, we need to debit to reduce. And we're going to do that in the account reclassification adjustment, parentheses OCI. We're going to report it as part of other comprehensive income, and then that's going to get closed to accumulated other comprehensive income, and then it's going to give us in balance an accumulated other comprehensive income of 0. We're going to credit the fair value adjustment account to eliminate the balance in fair value adjustment account, and then we're going to record the sale. We get cash of $100,000. We eliminate the investment in the bonds at their cost, $92,000, and we record a gain on sale or gain on investment in bonds through net income of the $8,000.